In continuing with our mid-year review theme, we're shifting our attention to your insurance deductible. The point is, the deductible may look like one small number on a policy, but it can become a major cash flow problem after a claim. If your deductible is $1,000, $2,500, or even higher, that is the amount you may be responsible for after your insurance company pays its portion of a covered loss. The problem is that many people choose a deductible based on saving money on the premium or rate. They never stop to ask whether that amount would be available if a storm damaged the roof or an accident put the car in the repair shop tomorrow. A higher deductible can be a smart way to control insurance costs, but it can also leave you with coverage that may not be in your best interest when you need to use it most. Stay with me until the end, because I am going to walk you through a simple deductible tune-up that can help you balance monthly savings with the cash you would actually need after a claim. So let's get started. We know the deductible is a portion of a covered loss that you agree to pay during a claim. I get questioned about the deductible all the time, so I need you to keep in mind the deductible is not a fee that you pay to the insurance company before every claim. I understand back in my parents' day, this used to be the case. So this is how a deductible works today. Allow me to use this scenario. In many property claims, the deductible is subtracted from the amount the insurer pays. For example, if covered repairs cost $6,000 and the deductible is $1,000, the insurer will pay $5,000. Then you're responsible for the remaining $1,000. In the end, the exact settlement can depend on the policy, the type of claim, depreciation, and other coverage terms. That is why I do not view a deductible as just an insurance decision. I view it as a cash flow decision. The right question is not simply, how much can it save on my premium? The better question is, how much could I pay on short notice without using a credit card, missing another bill, or delaying an important repair? Once that amount is clear, the premium comparison becomes much more useful. Let's start with examining a higher deductible, which can make sense when the savings are meaningful, and the household has enough money set aside to absorb the added risk. Suppose raising an auto deductible from $500 to $1,000 saves $120 per year. You are accepting $500 of additional responsibility in exchange for that annual savings. If you already have the full $1,000 available in an emergency reserve, that trade-off may be reasonable. However, the savings should be measured against the added exposure. In this example, it would take a little more than 4 years without a claim for the accumulated savings to equal the additional $500 you agreed to pay. That does not automatically make the higher deductible good or bad. It simply gives the decision context. I want the deductible to match the financial plan, not work against it. That brings me to the point where a higher deductible can create more pressure than savings. A deductible is probably too high when paying it will require new debt, delay repairs, or force money away from important essential expenses like rent, mortgage, or utilities. For starters, home insurance deserves special attention because some policies use different deductibles for different types of losses. A policy might have one deductible for most covered claims and a separate wind or hail deductible. That separate deductible may be written as a percentage of the insured value of the home rather than a flat dollar amount. For example, a 2% wind and hail deductible on a home insured for $300,000 means you're responsible for a deductible of $6,000. That is very different from a $2,000 flat deductible. I want clients to understand the dollar amount because a percentage can look smaller on the declarations page than it feels after a storm claim. Let's move over to auto insurance, where the same principle applies. An auto collision deductible applies to cover damage from a collision. A comprehensive deductible generally applies to covered losses, such as theft, vandalism, hail, fallen objects, or an animal strike. Those deductibles do not have to be identical, and the best choices can depend on the vehicle's value, loan requirements, savings, and premium difference. A realistic example shows why this review matters. Imagine a family that raised the home deductible from $1,000 to $5,000 to reduce the annual premium. The change looked manageable because there had not been a claim in years. Several months later, a covered windstorm damaged the roof. The repair could not be postponed, but the family had only about $2,000 in emergency savings. The insurance policy still responded according to its terms. The problem was not that the family lacked coverage. The problem was that the deductible did not match the family's available cash. The remaining amount had to be financed. Interest and monthly payments then reduced the value of the premium savings that influenced the deductible choice in the first place. The lesson is simple. A deductible should be high enough to help manage premium costs, but not so high that one covered claim creates a financial emergency. Here's how I recommend tuning that number. First, I would identify every deductible on the home and auto policies. I would pay close attention to deductibles for separate wind, hail, hurricane, name storm, flood, and earthquake for home insurance. Then, understand comprehensive and collision deductibles for auto. The goal is to make you understand how they all apply. Keep in mind coverage and terminology vary by state, carrier, and policy. Second, I would convert every percentage deductible into a dollar amount. That makes it easier to compare the policy with the money available in savings against the actual deductible. Third, I would ask, what amount could be paid within a few days without borrowing? I do not count a credit card limit as emergency savings, but I understand if you have to do what you have to do. If the deductible is higher than the available reserve, I would then review the cost of lowering it. Finally, I would compare the premium at 2 or 3 realistic deductible levels. Then, look at the annual savings, the additional amount at risk, and how long it would take for the savings to make up that difference. Sometimes a higher deductible is worth it, and sometimes the premium savings are too small to justify the extra financial exposure. Then, I would also revisit the decision after a major life change. For example, a new home, a different vehicle, a business change, retirement, a reduction in household income, or a large expense can change what feels affordable. With those numbers in front of me, the final choice becomes much clearer. The lowest premium is not always the lowest total cost. A deductible is part of the financial responsibility you keep, and it should fit the way money actually moves through the household. I recommend checking the deductible, translating it into real dollars, comparing the premium savings, and confirming that the money will be available after a loss. That short review can help prevent an insurance claim from becoming a cash flow crisis. The goal is not to choose the lowest deductible or the highest deductible either. The goal is to choose one that provides a reasonable premium while remaining affordable when life does not go according to plan. Now, if this content was helpful, place a thumbs up in the comment section. This really helps with engagement and assists with pushing out this video to others. Also, word of mouth is good too, so please share this content with someone who may benefit from this topic. Then check out my video library. I have information on home, auto, business, specialty insurance, and retirement. With all this being said, subscribe to my channel and help me get to 1,000 subscribers. But don't stop here. Check out my next video on your left for more insurance and financial tips. And as I like to say, call Jaded today.